Lacklustre at best appears to be the market expectation of this round of profit reports. As we reported earlier, Myer's share price was slashed 11.5% today after a profit downgrade. While the market was quick to punish the retailer, it may not be so harsh on others, with a lot of bad news already factored in. Michael Troy reports.
Sometimes low expectations are a good thing.
As everyone knows, there were a series of rate hikes and a lot of businesses really didn't get any momentum going at all through the year.
The two major sectors worst hit by the Reserve Bank's aggressive rates policy will be building and retail.
We've got quite a difficult time, and we've seen the first profit warning from Woolworths really in living memory.
Greg Hoffman from The Intelligent Investor says the credit binge of the last 4 years is over, and the share prices of a lot of the retailers, especially in the discretionary end, have pulled back in the last 6 to 12 months.
We had a lot of tailwinds that came together for the retail industry, and a lot of those now are reversing. People are paying down their debts and being a lot more conservative in their approach.
On the positive side, the mining boom continues to boost the coffers of mining-related companies.
We don't think that China will have a hard landing, and we think growth in India will continue the way it has for the last few years. So we think that will remain a support for commodity prices, and it will also obviously be a big support for the aggregate earnings in the Australian market.
Another area of support will come from the US market, which has been picking up steadily from the global financial crisis, with earnings for companies there expected to hit a record high for 2011. Australian banks, though, will continue to be hindered by the high cost of overseas credit.
The global financial crisis still impacts them materially because so much of their funding comes from the offshore markets, and the price of that funding has increased so much over the last few years.
That cost has eaten quite heavily into margins, but analyst Brett Lemessurier says they've in turn passed that on to borrowers.
They should report very little growth in the top line. But of course, as the bad debt charge falls a little bit, then it'll look like profits, and profits will be increasing. But that's really the major reason why we'll see increases in profits. And of course, the headline numbers will be quite large, which will lead to, no doubt, various political statements.
In the insurance sector, it's been a big year for natural disasters, with the Queensland floods and Cyclone Yasi. Suncorp in particular has been hit hard, and while the disasters may not be reflected in these results, the impact is expected to flow through to higher premiums.
How many are they going to get and how severe is it going to be? And they don't factor in enough. They haven't factored in enough, as we'll see in the results.
Despite the talk of room to manoeuvre, companies will still have to deliver a reasonable scorecard or, like Myer, risk a backlash from investors.